Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. Well, this week it's not so much a trick that we're looking at, but rather an answer to a question that was emailed to me by one of the members, and he was interested in knowing a little bit more about how we actually enter a support and resistance based trade. And I'm glad that he wrote this because I tend to forget that from time to time we need a refresher of some of the more basic concepts. So if there's ever anything that we're doing that you're not clear on, I hope that you would drop me an email at eric@tradershelpingtraders.com so that I can answer it for you, or you can also post it at the forum. I'll be sure to get it at the forum as well. Alright, so let's take a look at how we actually go about entering a support and resistance trade. And fortunately, it's not as difficult as you might think. There's a lot of ways to enter a market. You can enter on a stop, which means that the market will, or your entry will not become active until the market trades at the particular price that you have specified, and that's called a stop order. You can also just buy a market order or sell a market order, which means that whatever the current bid or ask is, depending whether you're buying or selling, that's the price that you will get filled at. And usually there's at least one, sometimes two ticks slippage to allow you to get into the market at the market price. That's the spread between the buying and the selling, but we can get into that another day. And then there's also limit orders, and limit orders are quite simply the limit, the maximum that you will pay for a particular commodity. So if you set a limit price, that means that that is the worst price that you will get filled at. It used to be that you would enter a limit or better, but now it's always assumed that you will accept a better price than the limit price. So the limit puts a limit on how much you are prepared to pay for a particular commodity. A market gets you into the market immediately, and a stop gets you into the market at a specified price. So what we tend to do more often than not is we tend to use stop orders. And what that means is we will set a price that once the market trades there, then our order automatically becomes a market order and we are in the trade. And there's variations on this as well. You can use what is called a stop limit order, which is a combination of the two concepts, namely that your price or your order will not become active until the market trades at a specified price, and you've also put a limit on how much you're prepared to pay for that particular commodity. So it's actually the best of both worlds, a stop limit order, in that you will not experience any slippage. However, you may also not get filled because you have put a limit on how much you're prepared to pay. All right, let's take a look at a few examples, or at least one example, and hopefully this will become a little more clear on how we like to trade support and resistance, and consequently what entries we will use for that. Okay, here is the July sugar chart. This is actually the daily chart. Before we get too far along, let's flip over to the weekly and see where the market has been and where it's going. So you can see that sugar a few months ago made a huge spike, topped out, and then abruptly fell off, and we are back down here at a rather significant level of support. We have old resistance back here from a couple, 3 years ago, and we have old support here from a year ago, and we are very, very close to this particular price level. In fact, close enough that we might consider getting a little bit bullish on this market. All right, so that's our long-term perspective. Let's go back to the daily chart, and you can see that in fact prices are struggling as we're getting closer to this long-term area of support. So let's say that you've determined that it's time to get bullish on sugar. You say, look at all this support that the market's given us the last little while, and remember, support is our red-green bar combination. So we have support here, we have more support here, we have more support here, and then to finish the week we have support as well. So it looks like we've got a lot of support at or near 16 even. Now let's say we wanted to buy this market long. I refrain from just buying the market on the open or the close, or just going in and saying I want to buy the market. And the reason for that is I have found that a long time ago it is a lot more difficult to predict what the market will do next as opposed to reacting what it is doing. So in other words, if we say that we want to buy the market come Monday, we are making a prediction that prices are actually going to have to head higher. Now that may or may not be the case. A safer way to get into this market is to say, if the market breaks Friday's high, which looks like it was at 1679, if the market breaks through the high, then I will buy it. So let's say we're going to give it a few ticks, and we're going to say, well, actually, why don't we go the other side of 1700? We will buy the market if it hits 1701. Now, what does that do for us? First off, it gets us into a position where hopefully we are getting into a trade with some momentum. The market will have to break the resistance on Friday's high, and remember, there's automatically resistance on the daily highs and lows, because that's obviously as far as the market was able to travel in either direction. So we have obvious resistance on the high and obvious support on the low for every single day that the market trades. So we know there's some resistance at 1679, which was Friday's high. If we get above there, then we will look to buy. So what this does is it essentially makes the market prove us right before we get into a trade. There's a little bit of security in that because, as I mentioned before, we're looking to pick up a trade that actually has some momentum to it. Contrast that with saying, well, I'll buy the market, say, at 1640 on a stop limit. Or I guess in this case, a limit order, because the market's actually closed up here. So what a limit order would say is the most I will pay for sugar is 1640. But I'm going to go long. I have to commit to a position, either long or short, and say I will buy at 1640. So once again, we're back into prediction mode. Now the upshot to prediction mode and using limit orders is, as you can see, our risk is a lot smaller. Here we're only risking 40 cents, whereas if we're trading, looking to enter at 1701, we're risking well over 100. Well, not well over, but just over 100 to get into this trade. So that makes a big difference because our risk is considerably more using, I'm just trying to get you a rough idea here, our risk is considerably more using this break technique, this breakout technique. The upshot is that hopefully, as I mentioned, we will catch a market that has some momentum and it will keep going higher from here. So on the one hand, it serves to help keep us on the right side of the trade. However, on the other hand, if we're wrong, it will cost us more money to be wrong. The other thing that I look for is I look for the market open. I do not like to see the market open beyond my entry. In fact, I like to see it open at least a few ticks below my entry, and preferably not too far from the previous day's close. And what does that do? Well, once again, it shows us that the market is behaving normally and that it's not going to fade against us. If I make this just a little bit bigger, this isn't the best example of a fade, but you'll get the general idea. If I back this chart up a couple of days, let's say that you wanted to sell below this low. The low is 1612. Let's say you're going to sell 1609. You think the market is heading lower. You want to sell this bar. The very next day, the market actually opens below our intended entry. Now, if you were not watching the opening range, you perhaps would have just sold it off of the open. After all, it went below 1609. We were looking to sell, so the open came at 1600 even, and you would have ended up selling the low of the day. The problem with gapping markets, or markets that open too far from where they left off, is that they will have a tendency to reverse on themselves and fade. That's what a fade means, is that the market will open well beyond where it left off and then spend the rest of the session moving against the open. As you can see, that's exactly what happened here. Now, the reason that's bad should be obvious, is you are not only getting a crummy fill and thereby increasing your intended risk, but you're also leaving yourself open to the possibility of a fade and the market setting up to move against you. So for those reasons, I always tend to use orders that are beyond the daily range to make the market prove me right, to come to me, build some momentum before getting me into the trade. And I also watch the opening range, or at least the market open, to try to avoid any market that would possibly fade against me. And that's just the way I've always done it. It's what works well for me. As I mentioned, there's a dozen different ways to get into the market. But personally, I feel that for the small trader, these benefits far outweigh the little bit of added risk that you may have to assume, because it does help keep you on the right side of a trade. I hope that helps. I hope that answers your questions. That's this week's Tricks of the Trade.